Welcome to The Landlady Listens. The podcast where we talk all things real estate, development, and the mindset it takes to build your dream life. Okay, hey guys. It's Landlady. I'm your host, Meg Hayden, real estate broker, new construction expert, and a believer in making big visions into a reality. So if you're ready to build it, dream it, and live it, let's dive in. Hey guys, it's Meg Hayden, the landlady. I'm super excited for today's episode. Are you interested in purchasing a home? Or are you interested in already rehabbing the home that you have? We have an amazing guest today, but I want to welcome you to the Landlady Listens, where we turn blueprints into reality. I'm your host, Meg Hayden, and I am a real estate broker, development strategist, and mom of two. So let's dive in. Today, I am with Ryan from Loan Depot. Here he is. Yeah, hey, Ryan.
How's it going, guys?
So let's tell us about you.
Been in the business for about 3 years now. Great thing about that is I work with an amazing management team. They have over 60 years of experience in the industry, between my sales manager, my branch manager, and my development manager. They're all amazing. My family has been in the business for over 80 years. My dad's in the business. My grandfather was in the business. So I've known the term FHA since I was 5. Yep.
It's a good one to know.
Yep.
So when people are starting to look at properties to purchase, what are they going to need to have in order to get the whole process going?
Of course. So there are really 3 pillars of getting pre-approved. It's going to be your income, your assets, and your credit. So it's a combination of all 3. It's really just important to speak with a mortgage loan officer to kind of go through that process and really put you on a game plan if one of those pillars aren't exactly where they need to be.
All right. So the other day I had a client talking to me about her credit and that it wasn't amazing. So do you have any advice for people who are worried about their credit? I always tell them to just talk to a loan officer first and see where they are, because there are still some programs that they would be able to purchase a home still. So tell me a little bit about that process.
Absolutely. So a lot of people, they see the Credit Karma, the Credit Wise, the credit monitoring apps of the world. They see that it's not great, and they don't realize that it's not that bad for getting a mortgage. Now, it could be better if you have a higher credit score, but we have different ways to bump up the scores in the short term and the long term. Different credit algorithms that we put in a unique scenario. They could pay off 1 debt, they could pay off 5 debts, really put them on a credit game plan. If it's too much for our credit algorithm, they need a lot of help where it's more of like a 6 to a year plus game plan. We have credit specialists that are, it's a nonprofit, and he really helps people out. It's amazing.
That's awesome. Who's that?
Stephen Roberts, Bedrock Credit of America.
All right, cool. Yeah, I think it's just important for anytime you have a goal, you have to assemble your team. Mm-hmm. And part of assembling that team is, number one, working with the loan officer to see, where your finances are. And also, obviously, to call me, Meg Hayden, your favorite real estate broker, to start getting to look at where it is you want to do and where you want to purchase, but also what your goals are. So as a first-time home buyer, tell me a little bit about some of the programs that we have for first-time home buyers.
So in Rhode Island, there are great first-time home buyer programs with Rhode Island Housing. They do have some drawbacks where you have to have a higher credit score. It's a little bit more difficult to qualify for, just being credit-wise. There's also an income limit. Now, our in-house programs, they're not necessarily specific for first-time home buyers. They're a little bit more lenient on credit score, and it makes it a little bit easier to qualify. And they give you 5% of the purchase price, which is amazing. With a seller concession, I've had people literally come to the table with like $1,000.
So tell me about the 5%.
So it's a 5% second loan. So it's not a grant. It's something that you do have to pay back essentially. And that gets tacked on to your total mortgage payment. It's a separate payment when they go to make their payments in the first couple months, or throughout the whole process. It's two different agencies, but it really helps people qualify for the home that they want, because a lot of times in today's world, it's the down payment and the closing costs that you have to bring to the table. That's what's really holding people back.
So that 5% is the down payment, or talking about down payment assistance?
So it can be used for either or, down payment or closing costs. In most cases, it's used towards the down payment, because if you're using a seller concession, that can only be used for closing costs. So 9 times out of 10, it's down payment. But it's great because FHA, the minimum down payment is 3.5%. So 3.5% of that 5% goes towards the down payment, and then 1.5% goes towards the closing costs.
I see.
Yeah, so it's really, really valuable. We were one of the first people to bring it to market. I only know of one other company that has something like that.
Awesome. So tell me about, like, what are closing costs as a first-time home buyer? What's in that?
A lot of it comes down to third-party fees. So the only fees that you pay loanDepot are processing and underwriting fees, just to pay for the processors and underwriters for their time. Now the other fees are like your credit report, your government recording fees. There's a lot of other little government stuff. But most of it comes down to title fees and also prepaids. So what prepaids are, it's funding the first year of your homeowner's insurance and your property tax. And then what happens is you also fund an escrow account that it's always in the future. So what you're paying each month on your mortgage statement, it's funding the future property taxes and the homeowner's insurance. So you always have a surplus in there.
All right, so for first-time home buyers, then you can be purchasing a property with 3.5% down as an FHA buyer, or the 5% down, which helps you with the closing costs. And typically, when we're purchasing a property, we are either increasing the purchase price to allow for those closing costs, and the closing cost would be what? Typically. So
national average is 3 to 5%. We tend to be closer to the 3%. It really just depends on that particular area. But its national average is 3 to 5%.
Okay. So so we have the down payment assistance program. Tell me what else first-time home buyers need to know.
So it's like Meg said before, it's really important to have the right team working for you. We have over 900 mortgage products available to us, so it's really important to speak with someone as qualified as myself. I treat everyone like family. It's a family-owned business, so.
He's Italian.
I'm Italian, that's my catchphrase. Yeah, everyone is treated like an Italian when they work. They're family. So what I do is I put myself in their shoes, and with my mortgage expertise, what would I do if I were you? Does it make sense to go FHA? Does it make sense to go conventional? Again, we have so many different products. It's really important to have the right person working for you.
Awesome. So I always believe that any first-time home buyer should be purchasing a multifamily when they're making their first purchase, because it's the only time that they're going to be able to purchase something with 3.5 or 5% down in terms of an investment property. Typically, if you buy a single family home first, and then you're like, you know what, I'd really like to dip my toe in investing, then you're going to have to put 20% down. So for any first time home buyers that are thinking about buying property or buying their first home, I would always 100% recommend purchasing a 3 to 4 unit property to be able to have supplemental income in the future. It's just a retirement plan. It's just one investment, and you can live there for 1 year and then be able to say, FHA, I need to refinance this property and get out of the FHA loan so that I can buy my single family home. So that is something that I always recommend. So when you're buying a multi-unit, how much do you really need to have saved to be able to qualify to purchase a property?
Yeah, so just to keep in mind, in the mortgage world, we say it depends quite often. So it depends on mortgage program. It depends on how many units there are. So for residential properties, if you want to get a residential mortgage, it has to be 4 units or less.
Right.
Now,
if it's 5 units above, for our listeners, if it's 5 units and above, then it's a commercial one. So 4 units and under.
Just to point out, piggyback off of that, you could use, getting a little ahead of ourselves, but you can use a renovation loan to then make it a 4 unit and make it residential.
Wait, say that again?
So what's cool about the renovation loan, let's say you have 5 units, they're like stacked on top of each other or side by side. You can use the renovation loan to remove one of those walls, make a 5 unit into a big 4 unit. So one of the units is basically 2 units, but put together, and then it qualifies for residential. So you don't have to go through the hoops of conventional and all the excess fees. You don't get to work with me because I can't do commercial rather. So that's just a way to turn a 5 unit into a 4 unit, make it residential.
Wait, so you could purchase a 5 unit with a renovation loan to make it into a 4 unit.
Correct.
For it to qualify. That's interesting. I never thought of that. So getting back to the multi-units, in terms of reserves for multi-unit. So let's say the multi-unit has 4 units. How much is the bank looking to have in terms of reserves?
Again, it depends on program. There are certain programs that require 6 months of reserves.
Okay.
There are others that require less. Some only require 2. FHA for 1 to 2 units does not require reserves in most cases. Again, it depends on what's called automated underwriting findings. So it depends on the risk level of that client. I've had clients buy multifamilies with no reserves because their risk profile wasn't that high.
So a reserve, for anyone who's listening, is having essentially the payments already, insurance, taxes, and how much you would pay for it.
Yep.
Each month, you'd have to have 6 months of that. So whatever that total amount is, say it's $4,000 a month for everything, you'd have to have that either 3 months typically or up to 6 months. But either way, I think it's a good rule of thumb to have that amount set aside, some kind of reserves, just based off of, wherever you're buying, you don't know whether the tenant's going to pay or not going to pay, or you might have, an issue with occupancy. So I think it's just a good rule of thumb to definitely have those reserves in place, and that you're thinking of that when you go to purchase a property. So not only are you going to have the 3.5% to 5% down, then you would want to have at least 3 to 6 months of reserves to be able to purchase a property.
Yeah, in most cases, not necessary for qualification, but it's definitely the smart play.
Yeah.
For sure. For sure.
Yeah. Just have it there just in case. And so the other thing you were talking about is for the down payment assistance programs, that means that you would have money towards your down payment, and when you go to sell the property, so it's an upfront loan, right? Some of them are 0%, some of them have 1% on the loan, but typically, when you go to sell your house, so this is for even listeners who have a property, who've accepted a down payment assistance program. When they go to sell the property, you have to make sure that at the end, when you go to sell the property, that you realize that not only do you have to pay off the bank, you're going to also have to pay off that amount that you had initially. And so that's something that's really important. When I sit down with my clients as sellers, I offer a net sheet. So I typically say, hey, listen, the property, we can sell it in a range. So I say 350 to 400. And then it calculates commissions, attorney's fees, tax statements, and also what is owed to the bank. And so just make sure that you remember that you took that down payment assistance, because your numbers are going to be off once you're going on to your next property. So I think it's something that is really important to definitely remember when you're going to sell your house. So I love a reno loan. Let's talk about that.
Of course. So renovation loans, they're a great tool for people that love a particular house or a particular area, but they're getting priced out of the market. Especially,
which I think a lot of people are.
Yep. And especially in Rhode Island, there are a lot of older homes. Rhode Island has been around for centuries. So my friend has a house that was built before the Declaration of Independence. So there's a lot of tired homes, houses that need a little bit of TLC, and having a renovation loan is really powerful for that, because they don't have to come up with the renovation costs out of pocket as much.
And we actually had a property that needed some work, not anything crazy, and we're doing an open house this weekend. Also, I always bring in a renovation loan, because if there's a property that needs work, this is a wonderful opportunity to be able to make it into what you want, while not coming out of pocket with it or doing a home equity line. So how do you even structure those when you're going to, so you look at a house, you're like, all right, this needs work, and I probably needs like $20,000 or $30,000 worth of work. Tell me how that loan even looks like, or how do you even write the letter of intent?
Yeah, so we have in our system, we have the purchase price, but we also have what the estimated cost of repairs. And Loan Depot is fantastic. I couldn't tell you all the different little things. I just put in what that cost would be, and it automatically calculates it. One thing that I will say, even if you don't use myself or Loan Depot, make sure that if you're going with a renovation loan, they have a renovation department. What that means is we have a specific department that handles all of the back end stuff that goes into communicating with contractors, with FHA, with HUD, all of that stuff. It will dramatically reduce your timeline if you have a renovation department. If you don't, a lot of other lenders are like, all right, it's going to be 45 to 95 days, because it's a lot of extra work and the loan officer has to do that. So I had renovation products at my previous company, but I would not want to do them because it adds a lot to your casework, and it really inhibits you from working and helping other families. So having a renovation department, again, even if you don't work with me, you want a lender that has a renovation department. It's super crucial.
So when you're going to look at a property, then you should have your contractor that you have vetted and read their reviews and make sure that they are good. So let's say the property needs $30,000 worth of work. Obviously, I would recommend that when you're going to purchase the property, that you're going in there with your contractor to take a look and actually calculate the actual costs. So you're saying it takes 45 to 90 days, typically with other companies. So you purchase the property, sign on the dotted line, it's yours now. What are the next steps after that?
So you're saying when offer accepted, or you're
offer
closed? Offer
accepted, you're closed.
Like money's in the seller's account. So the next step is the renovation department coordinates with the contractor. So the work has to begin within a month, Now it depends. In New England, where we have winter, so obviously they can't do some exterior work if they have to paint.
Can't paint, yeah.
Stuff like that. So within reason, but work has to be started within a month. There are certain disbursements that happen to the contractor. We do disbursements just to protect the buyer. Let's say if we just gave $50,000 to a contractor, then he runs off. Now we're in a lawsuit. Like we're chasing the money, and
Nobody wants that.
Nobody wants that.
No, we just want our home done.
Absolutely, and we want to protect our buyers at the end of the day.
But that is a good point. So like, make sure whenever you are working with a contractor that you're not giving them the full amount up front. There's so many times where they're like near the end and then they're asking for another X amount because they've run out of funds. So it's super important to, whether you're doing a loan or you're paying it for yourself out of pocket, that you make sure that you're not giving anybody the full amount and that they're completing the job. And at the end, you know, here's the money for the supplies. Once it's done, then we can pay the rest. But talk to me about how the disbursements happen within Loan Depot.
So it goes, the contractor will submit a scope of work at the beginning, like what everything will cost in different phases. So we'll disperse based off of phases. And that's a good point, actually, that you brought up with the money running out at the end. So we factor in contingency reserves for that exact example. Like, oh, we didn't realize that something else happened. We were opening up a wall and then there was a leak and we weren't expecting this. So we have contingency reserves built in for that example. And if everything goes exactly as planned from start to finish, those contingency reserves get refunded back to you. It's just a reduction in the loan.
Okay, so explain the contingency reserves.
So it's funds that are set aside from the beginning of the process. It's based.
So you say let's say it's 30 grand, right? That we're gonna do in terms of renovations. So how much money is typically set aside?
It's typically about 20%.
Okay.
That's set aside. So it's in a 30,000 plus 20%. So it's like 36,000. That's allocated towards the renovation. And then that's what the contractor tells us is the 30,000, but we have the 36 ready to go.
And the 36 then is from the buyer already rolled into their loan. Okay.
Yep, that's already rolled into the total loan amount. And then let's say it actually does cost 30,000. That 6,000 is then given back to the buyer.
Okay, that's awesome. So, all right, so we factor in how much it's going to cost, and we put that on top of the purchase price. And then, does it still have to appraise?
So it will be subject to. So with FHA, there's as is, where the house appraises as is. There's no repairs that is needed. With a FHA renovation loan, we notate that it's a 203K, that we're doing renovations, and then at the bottom it will be subject to. So it will be subject to certain repairs that need to happen to make it FHA approved. In a lot of cases, 9 times out of 10, it's all safety related stuff. So GFCI outlets, like about a bunch of other safety related items.
GFCI is electric. You don't know.
Yeah. So it's all based off of safety. It does have to appraise to a certain amount. We can go a little bit above with FHA. You can go 110% of the appraised value for your loan amount, which is nice for like roofs, for example. It may need a new roof. Roof doesn't add to the value of a house. So,
no, unfortunately.
Yeah, so having that 10% to cover something like that, where it's a repair that's necessary, but doesn't add to the value. It's not, you're not changing a kitchen or a bathroom that would add value back.
Yeah, so with a regular FHA loan, you typically, if you see any like peeled paint on the exterior, you're gonna need to have that done for the appraisal, for the FHA to be appraised and for it to go through. But with the 203K loan, the FHA 203K loan, which is the renovation loan, you would be able to have that, you know, that work completed as part of it, essentially appraising. So, so awesome. Is there anything else you wanted to talk about?
I think that's pretty much it. I mean, if people really want to know more, they got to contact us because we got all the information. Again, it's really important to have the right team working for you. I can't tell you how valuable it is.
All right, so I ask all my guests on the show, what book are you reading currently, or any recommendations that you would have?
I am going back and reading Audible books of Harry Potter.
Okay.
Just my childhood. So I listen to Audible books when I'm on my way to the office, when I'm getting ready in the morning. But I am, on a professional side, I am reading a book, How to Network. I can't remember the author's name, but yeah, it just everything is about networking in today's world. No matter what business you're in, it's really important to have, again, the right network that's working with you and working for you.
It is, and it's also about like having the right people, having the right energy. So, do you have any mantra? Do you have a mantra that you go with? No mantra.
I'm Italian.
I'm Italian. He's Italian. So, thank you so much, Ryan, for being here. Where can people connect with you and learn more about you?
Of course, my cell phone, 401-688-1088. My website, loandepot.com/rferranti, Ferranti. At the end of the day, if someone needs to contact me, you can always contact Meg. She'll point you in the right direction.
All right, well, that's it for today's episode of The
Thank you so
Landlady
much.
Listens, where we turn vision into reality. Remember, success starts in your mind before it ever shows up in your life. Keep believing, keep building, and most importantly, keep taking action. Until next time, trust the process, bet on yourself, go create the life that you deserve. And don't forget to like, subscribe, and share this episode with anyone who needs to buy a new house, because we're here. So, love you. I'll talk to you soon. Give me a call. Meg Hayden, your favorite real estate broker, 609-598-2232. Thanks, guys. That's it for today's episode of The Landlady, where we turn your vision into a reality. Remember, success starts in your mind before it ever shows up in your life. Keep believing, keep building, and more importantly, keep taking action. And until next time, trust the process, bet on yourself, and go create the life that you deserve. Don't forget to like, subscribe, and share this episode with someone who needs to hear it. Love you.